Ever wondered why some people seem to multiply their wealth effortlessly through investing? Well, investing is not some esoteric art. It's a method of making your money work for you, rather than you working for your money. It's about putting your hard-earned cash into ventures, stocks, or assets that have the potential to grow over time. The key here is smart investing. It's not about getting rich overnight or following the latest trends. Instead, it's about understanding the principles of investing and making calculated decisions that lead to steady, long-term financial growth. To help you navigate the world of investing, there's a classic book that has stood the test of time. It's called The Intelligent Investor. This book doesn't promise to make you a millionaire overnight, but it does offer valuable insights into how to approach investing intelligently and methodically. Investing isn't a gamble. It's a calculated risk that can lead to significant rewards. There are two types of investors, defensive and enterprising. Which one are you? The defensive investor is akin to a careful gardener. They seek safety and freedom from bother. Their investment strategy is akin to planting a seed and letting it grow, nurturing it occasionally but largely leaving it to nature. They prefer a hands-off approach, investing in diversified portfolios of bonds and high-grade common stocks. Their goal is to avoid serious mistakes or losses, and they are content with a reasonable return on their investment. Now, let's consider the enterprising investor. They are the adventurers of the investment world. They are willing to dedicate time and energy to actively manage their investments. They are on a constant lookout for opportunities to buy low and sell high. They actively seek out undervalued stocks and bonds and are not afraid to take calculated risks for better returns. They are the treasure hunters, the ones willing to dig deep and get their hands dirty in the quest for gold. But here's the key. Both types of investors, the cautious gardener and the daring adventurer, can be successful if they follow the principles laid out in the book. They must make decisions based on thorough analysis, ensure adequate safety of principle, and strive for a satisfactory return. Whether you're a cautious tortoise or a daring hare in the investing race, success lies in understanding your style and sticking to it. What if I told you that there's a way to minimize your investment risk? Welcome to the principle of margin of safety, a concept that can be your safety net in the unpredictable world of investing. It's not just a safety net, but the central concept of our discussion today. The margin of safety principle suggests that we should only buy when the price is significantly below the intrinsic value. What's intrinsic value, you ask? Well, it's the real fundamental value of a stock separate from its market price. This value might not be precise, but having a ballpark figure can help us make wiser investment decisions. So how does this principle help us? Picture this. We have a tightrope walker balancing on a wire high above a concrete floor. Now, wouldn't it be safer if there was a safety net below? That's exactly what margin of safety provides us as investors. It's our safety net against errors and downturns in the market. By buying at a price below the intrinsic value, we create a cushion, a margin of safety that shields us from unexpected market fluctuations or errors in our judgment. It's like getting a discount on a purchase, but a discount that could potentially save us a lot of money and stress. Remember, the intelligent investor is a realist who sells to optimists and buys from pessimists. Investing is a strange game. The more excited you get, the more money you're likely to lose. It's a paradox that often baffles newcomers, and even seasoned investors. The more active you are in the market, constantly buying and selling in a quest for quick gains, the less likely you are to achieve strong results. This might seem counterintuitive, but it's a reality grounded in the principles of long-term investing. The stock market isn't a get-rich-quick scheme. It's a platform for growth, and growth requires time. Patience, discipline, and a long-term perspective are your most valuable assets. Jumping on the latest hot stock or trying to time the market might seem exciting, but more often than not, it leads to disappointment. The key is to maintain a steady course, making informed decisions based on careful analysis, not frenzied speculation. So remember, in the world of investing, slow and steady often does win the race.